folks, Scott here, and this is the wrap for Monday, November 4th. So, interesting day. I know I've never said that before to start off a video, but it was sort of interesting in some ways. In other ways, it wasn't, because I actually did no trades today. But I want to explain why I passed on the gap trade, which in retrospect ended up being a good call because I would have lost money. But before I do that, let's talk about what tomorrow may bring us. This is a backtesting workspace for me. These are 5-minute bars all scrunched together, showing each individual day's action. We had 3 days of sell-off. In fact, you can see we tested the trend line, just eyeballing it, right? Drawing that trend line down. Whoops, like that. Capped up, tested it, bounced higher. Tomorrow is the 5th. It's a risky day of the month from a pure calendar day perspective. I think it's due to normally get a little bit of pullback after run-ups into the end of the month. Pause a little bit and then continue higher during real bull markets, and that could happen here, right? That's essentially what's happened the past few days. But and there are other considerations. There's a green hammer stick in play and so on. But I thought just to start things off, something that may be of equal or greater value would be, since we're now in November, let's look at the results of fading gaps in November historically, past 10 years, when above the 10 and 200 day moving average. So November gaps above the 10 and 200 day moving average. And over the past 10 years or so, there have been 80 trades. It's 50-50 in terms of which way you're likely to gap in November during bullish markets, but there is a clear long bias. What I mean by that is the long trades, which by definition are down gaps. 82% of those is filled or finished positive by the end of the day, and short gaps have had a little bit lower than average win rate. The average gap fill win rate is about 70%. This is about 66%. The key thing is definitely favors the down gaps more so than the up gaps. So I'll rerun these numbers and share the results with our members tomorrow morning using intraday stops just to confirm if this is tradable or if this is riskier or what have you. So but I thought it was interesting. It does confirm the seasonal long bias you often get in November. All right. Before I show you what the worksheet showed, let me just point out we have a section of our website called Member Spotlights. It's like testimonials, but they're detailed. And you can see we have maybe, I don't know, 10 or 15 that have been done here. Just added another one this weekend, Greg from Los Angeles. Now we had Greg from Atlanta in the second quarter. This here in the third quarter is Greg from Los Angeles. And we talk about pro traders, and I tell people about pro traders. I had a guy challenge me one time, and well, I mean, I would call Greg D a pro trader, former Amex options market maker. I've been trading for 18 years, a dozen years on Amex. So he uses this, and he shares a lot of it. So I won't steal his thunder. I'll let you read. He's got some good advice down here at the bottom for new members, and encourage you all to check it out. All right, let's look at the worksheet first. We end up opening above the highs in not all the markets, but most of the markets. And you can see if opening above the highs, the worksheet, which is really, think of it like a cheat sheet. That's what I call it. A cheat sheet for analyzing all 8 individual indices. And on average, any gap above the prior highs was a little bit less than a 50-50 win rate, and it lost a little bit of money historically under similar market conditions. That's what it's really telling you. And so that gave me concern. No unique day factors. Doji above the 10, above the 200 is generally a positive, but anytime you see several days of a pullback from recent highs, whether it be 10-day highs or 200-day highs, that's generally going to be a risk factor for shorting up gaps during bullish markets. So without me even telling you, you should have discounted this number in your head, saying, okay, yes, it was a doji, yes, technically above the 10 and 200, but some of those indices are nestled like the NASDAQ right at the 10-day moving average. So you just have to discount the numbers. Use a little common sense when you see numbers like this. And my morning comments here posted around 9:20. I start them at 9:10. Post them around 9:20. Give or take a minute or two on average. And per the weekend wrap, fading up gaps after 3 lower daily lows above a 200. In fact, this shows the point I was just making after a recent period of weakness. Only a 50-50 kind of win rate. The gap is large, which I meant to detail that. I forgot to go back and add the actual amount, but it was definitely more than 40% of the 5-day ATR today. only about a 40% win rate historically, so definitely some risk there. Overall, neutral to risky gap guides, mixed factors at best, and bottom line, just 2 neutral setup. Not clearly bad nor attractive historically, so just no clear edge. That's what I'm trying to say. That's why I passed. I told people be prepared for a quick, easy fill. Prepare yourself emotionally, so you're not as surprised and it doesn't bother you as much, because I miss a bunch of winning trades. That's by design. If you look at all the ones I miss on average, in fact, not only on average, since I've been calling out trades and posting them live, had some members share some data going all the way back to 2007. I have saved people a ton of money, and I've avoided a ton of losing trades myself. When I say ton, I mean it's all relative to leverage, but many thousands of dollars, okay, depending upon your leverage, just about regardless of leverage. So today was one of those days. It was a good call to pass on it, depending upon the market. Russell never came close. It was bullish all day. NASDAQ went down, filled and consolidated. Dow filled and bounced a little bit. And the ES and the Dow, which tracked the closest together, the most correlated, came down. And I really thought we could get a fill here. There was a ton of confluence between 1756, which was where the ETFs filled, or I should say the spider filled. See, it was right at it. And we had a lot from our price guides that showed confluence here, and sure enough, it held the market in check. So technically, it was a good call, because again, had I faded it, I would have left it alone. It did not trigger my proximity rule. It would have closed out at the end of the day for a small loss, because it was above the open. So no gap trade. Oh, by the way, that's another positive, right? An unfilled up gap, even though it was just one market and gave it a shot. Well, that's not true. A couple markets still came close, but still, it will help increase the chance of odds for gap fill tomorrow, probably in either direction. Okay, so you might want to keep that in mind. No 15-minute or first-hour range trades were strong enough for me to take. Straight up, I was going to do a pullback on the high breakout. Some people did take the Russell, by the way. I like trading just one market, but quite a few folks have posted that. And I did no trades, so there you go. That was my quiet day, and that is the wrap for Monday, November 4th. Have a great one.